The screens are already bleeding red when Scott Bessent walks into the Treasury's secure auction room. No cameras, no speeches. Just traders staring at a wall of numbers that refuse to move. The 3-year note sale is minutes from closing, and foreign bids, the lifeblood of these auctions, are almost gone. Dealers type in emergency orders just to avoid the humiliation of a failed sale. Outside those walls, another headline breaks. China's 10-year government bonds now yield just 1.7%, the lowest in its modern history. It's not a footnote, it's a shift in global gravity. The US 10-year sits at 4.28%, more than double. In a world where the cheapest money often wins, that gap is as political as it is financial. The divergence isn't a slow leak, it's a waterfall. China's entire yield curve, 2-year, 10-year, 30-year, is falling together. Beijing can tap long-term capital at costs that Western governments haven't touched in decades. Meanwhile, the US curve is stuck high, unbent, even by the Federal Reserve's recent rate cuts. Mortgage rates remain pinned above 6.5% because they follow the 10-year Treasury, not the Fed's overnight target. 24 hours later, the Treasury's 10-year auction brings another blow. Foreign indirect bidders, central banks, sovereign funds, post their weakest participation since 2023. Yields rise during the sale, proof that buyers are demanding more interest just to take the debt. This is no market blip, it's a pattern forming in real time. By day 3, the 30-year auction is worse still. Foreign demand hits its second lowest point in 5 years. Yields jump across maturities because traders now see the auctions themselves as risk events. In 3 days, Bessent has watched the global market tell the United States that its debt is worth less than the price it's asking. China's absence from these auctions is deliberate. Treasury Department data shows Beijing's holdings of U.S. government debt have fallen to roughly $756 billion, the lowest since March 2009. They've been net sellers for months, steering their trade surplus into gold, domestic banks, and loans under the Belt and Road Initiative. The Financial Times reports that some of those loans, issued in U.S. dollars, now carry interest rates lower than what Washington pays to borrow its own currency. Here's the first hard reversal. In certain African and South American capitals, it is now cheaper to borrow U.S. dollars from a Chinese bank than from the U.S. Treasury itself. Bloomberg calls it an inversion of credit hierarchy, a phrase that wouldn't have existed in serious finance 20 years ago. Japan, still the largest foreign holder of treasuries, has slowed its buying as its own yields rise. Middle Eastern sovereign funds have diverted capital into ports, tech, and domestic infrastructure, where returns beat the locked-in yields of long-dated U.S. bonds. The administration's countermove has been tactical. Avoid locking in expensive 30-year debt, and instead flood the market with short-term treasury bills maturing in less than a year. That strategy keeps the near-term interest bill down. For now. But short-term debt must be refinanced constantly. Over the next 4 quarters, $9.2 trillion of existing debt will roll over, most of it issued when rates were far lower. Add $1.9 trillion in new borrowing for the deficit, and the total refinancing need exceeds $10 trillion. In a market where foreign appetite is shrinking, that refinancing treadmill is dangerous. Bank of America's data shows foreign custodial holdings at the Fed down $48 billion since March. Reverse repo positions down another $15 billion. That's not rebalancing, it's retreat. Here's the second irony. The United States still sells treasuries as the risk-free benchmark, yet investors now require a higher return to hold them than to lend to countries with less history and more political control over their economies. In market terms, Washington is paying a trust premium. The ripple is everywhere. Mortgage rates haven't moved despite 3 Fed cuts this year. Auto loans and credit cards are more expensive. Municipal bonds cost cities more to issue. Cutting the Fed's overnight rate affects bank-to-bank lending, but not the 10-year yield that anchors long-term borrowing. Without foreign demand to absorb supply, yields stay elevated. Even corporate America is feeling the drag. Refinitiv data shows U.S. investment-grade bond yields running nearly double those for comparable Chinese state-linked issuers. That erodes U.S. companies' ability to invest at competitive cost, and over time shifts where global expansion happens. Forget the spreads and the acronyms. Ask instead, How does the country that built the global financial highway end up paying a toll just to drive on it? The auctions aren't just sales, they're trust votes. And this summer, too many no votes came in. That trust erosion isn't just about deficits, it's about politics. The August auctions happened under the shadow of yet another budget standoff. Foreign investors don't need the fine print, they price the spectacle itself. Meanwhile, China's inflation is flat to negative, its trade surplus widening. The People's Bank of China still has room to cut rates. In real terms, after inflation, Chinese bonds yield more than US bonds. Currency stability adds to the appeal. The yuan has held relatively steady in 2025, backed by export surpluses and capital controls that limit volatility. For foreign holders, that reduces currency risk, making low nominal yields acceptable. By contrast, the dollar has weakened against a basket of major currencies since early summer, diluting the real return on treasuries for overseas buyers. The structure of the U.S. market compounds the issue. Treasuries depend on a layered ecosystem: primary dealers, foreign central banks, asset managers, hedge funds. When one major group steps back, the rest demand higher yields to fill the gap. That self-reinforcing loop is what I'm watching from my chair. The more they pay to sell debt, the more the next sale will cost. China's capital allocation underscores the long-term challenge. Instead of recycling export dollars into treasuries, Beijing funds overseas infrastructure, commodity deals, and equity stakes. These investments often use US dollars but bypass US debt entirely. That means no automatic recycling of trade surpluses into American bonds, a structural change in the flow of global capital. The Belt and Road loans illustrate the power of cheap credit. At roughly 4.2% average interest, they undercut Washington's own borrowing costs. That gap allows China to expand influence through ports, rail, and energy projects without firing a shot, while the US spends more just to service existing obligations. By the end of the year, interest on the US debt is on track to exceed defense spending, a first in modern history. Now, that isn't a default risk, but it sure does shrink the government's room to maneuver in any crisis. The Federal Reserve, well, it can't just fix foreign demand with those overnight rate cuts. Restoring appetite would require either higher real yields, which, let's face it, would worsen the interest bill, or policy shifts that convince buyers the long-term fiscal path is sustainable. Global capital is already hedging for a world that's less centered on treasuries. Central banks in Asia and the Middle East, they're building out local currency bond markets, reducing their dollar dependency. The IMF, they say the dollar's share of global reserves is now under 59%, the lowest in decades. Quite a shift, isn't it? The foreign retreat from US debt, it's not just visible in auction data, it's echoing in derivative markets too. Futures tied to Treasury prices now show unusually wide bid-ask spreads during auction weeks, a sign of thinning liquidity. Bloomberg reports that primary dealers are holding more unsold inventory post-auction than at any time since 2016, forcing them to discount positions just to clear those balance sheets. It's a bit of a squeeze, to say the least. Meanwhile, China's record-low borrowing costs are being amplified by a surge in domestic bond demand. Reuters notes that state-owned banks have been instructed to absorb additional sovereign debt, locking in yields that still outpace deposit rates. This creates a feedback loop. Stable demand lowers yields further, which in turn reinforces confidence among global buyers seeking a defensive position against US rate volatility. The World Bank's latest cross-border capital flows data shows a sharp pivot. In the first half of 2025, emerging markets excluding China saw net inflows of $84 billion, but China alone attracted over $120 billion. A reversal from the post-COVID years when capital fled emerging Asia. For the US, the same period saw a net outflow from long-term securities of nearly $35 billion. In other words, the auction room drama is just the surface. The tide is moving, and it's not coming back in Washington's favor. In this context, August's auctions are a signal. Treasuries will remain a core asset, but their premium status is eroding. If foreign buyers continue to demand more yield, the so-called risk-free rate will keep climbing, dragging the cost of capital higher for every borrower tied to it. In the Treasury's auction room, Besant is still at the table. The screens flicker with the next batch of bids. Smaller, thinner, costlier. He knows the numbers are bigger than him, bigger than the administration. Yet the shift is personal. The man once called the nation's top bond salesman is watching the buyers walk away. And that's the reframing. This isn't just about auctions or spreads. It's about the United States discovering that in a market it built, others now borrow cheaper, faster, and with fewer questions asked. Beijing's 1.7% isn't just a yield. It's a declaration that the center of gravity in global finance can move. And just did. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.